let's look at the investment management business, and for this we'll use as a proxy the mutual fund industry, which is a really good proxy because we've got plenty of data on it. We don't know exactly how others are doing when they're doing it. And that is, if you think about the mutual fund industry, it's charging around 2% a year for its wares. So if you can, and what are they getting as an average return? All these managers together, competing with one another, turn out to be average. What else is new? Everybody thinks they're going to be above average, but in the long run, the average is composed of that same group of managers, and they have to be average. But they're only averaging average before they deduct the cost of investing. So
the 2% is made up of management fees
very roughly, the 2% is around a little bit less, 1% or a little bit less in expense ratios, including the investment management fee, marketing costs, administrative costs, things of that nature. But it's around 1% on average for the industry now. When I came into the business, by the way, I will say parenthetically, with this tiny industry, the average cost was half of 1%. So as it got huge, the costs kept going up. So you got a double whammy. And not only much higher fees, a great business, but a bad profession. And great for the business side, bad for the fiduciary side. Great for the money managers, bad for the fund investors. This is not a proposition that I ever warmed up much to once I figured it out. So in any event, here we have the mutual fund managers. Let me just finish. Besides the advisory fee and total expense ratio is around 1%. Then you've got the funds are doing a lot of trading within their portfolio, and that's probably about half of 1%. And the funds are holding cash, where in the long run cash loses to the stock market, and that's about 10 basis points, and or 1/10 of 1%. And then left out of all the data we see are mutual fund sales charges, sales loads, now replaced importantly by advisory fees paid to registered investment advisors. But the marketing system costs a certain amount of money. And I used about 50 basis points for that. We don't really know. Some people don't get into the marketing system. They're just buying no-load funds. They're do-it-yourself investors. But some people are paying 1 or 1.5%. So I used 50. And so we're now at about 210. And that's in the article I wrote for the Financial Analyst Journal in January of 2014, called The All-In Expenses of Mutual Funds, of Investment Management.
Include taxes.
Well, I didn't even include, well, think about this for a minute. I left out a big cost, taxes, because I was talking largely about retirement plans. And then I left out a huge cost, which is the difference between the returns funds report, and the returns investors actually get. And since investors have bad timing and make bad choices, mutual fund investors lag the returns of their funds, according to Morningstar, looking at 15 years, by 2.5% a year. And if taxes are, say, 1.25% a year, that's another, well, let me make it 1.5 just for the fun of it. So I got a nice round 4 percentage points added to the 2. And then we'll take that one step further. So we've got a 6% investor experience. And this is not hyperbole. I mean, this is supported by the data. Sure. So then let's look at the stock market return. And let's assume it's 7% in the coming years. And let's assume we have 3% inflation. That's a 4% real return, which you're spending 6% to get. So you will.
Let's spend a little. Let's look at that. The 7%. So paying about 2% now in dividends, and then your estimate of about 5% growth.
Right.
Growth?
Yep. Okay. It's probably a little ambitious, but corporate America grows along with the GDP. It's not complicated. Not step by step, but they look kind of, if you get far enough away from the chart, they look like the same line. So I've now got to real return here. And the real return is on mutual funds over time. It's been negative. The real return after this. Now let's talk about the role just of costs on that for a minute. And let's think about an investor starting investing today, maybe like some of your students, who's going to invest for a lifetime. Think about a lifetime in 2 ways. Number one, let's assume that the market can deliver 7%. The historical return is 9% But I'm going to knock that down because the dividend is 2%. The yield is 2% less, and it will probably stay more or less in the new range of 2 rather than the old range of 4, 4.5. It's a guess, but it doesn't really matter. We're just hypothesizing here. And so that's a total of 7%, 5 and 2.
Yep.
And in the long run, as you observed, speculative return, the changes in people's willingness to pay, how much to pay for a dollar of earnings, over the very long run is 0.
Mm-hmm.
Big in this decade, negative in that decade. It's all over the place, decade by decade. But over your investment lifetime, you can expect it to be more or less 0.
Right.
And particularly compounded over that period, because if it goes from, let's say, 20 today to 15, 75 years from now, that's almost nothing in terms of annual rate. So let's look at 7 and 5. Just the market return, presumed market return, maybe rational expectations for market return, and subtract the cost, all-in costs of fund investing, leaving out those big costs, and say you get 5. Well, if you're young, starting out today with a 401k plan or a savings plan or an IRA, or maybe have a little bit of money you've earned on the side, and you earn 7%, you'll get about $160 for each dollar you invest over 75 years. It's a long time, but you're going to be here for a long time.
Yep.
So it doesn't mean you can do this for any time period you want. So that's $160. And if you get 5%, it's $40. At 2 percentage points is the difference between, can increase your retirement savings, if you can eliminate it, by 300%.
Right.
From $40 to $160. Yeah, that's right. Increased by 300%. And what is the alternative to that? Well, you can go to active managers. Now, if you own 3 or 4 funds at a given time that you like, we'll speak just about equity funds here. The average equity fund manager lasts 7 years. The average mutual fund, 50% could go out of business every decade. So the chances are, if you invest for 75 years, unbelievable as this sounds, you'll probably have at least 40 different managers. Is there any realistic possibility that 40 different managers charging 2% a year can get remotely close to the returns earned by the market itself, which is what the index fund does? It doesn't give you 7, in fairness. It gives you about 695, because you can buy our all market index fund for 5 basis points. I think it's over $10,000 you have to get to do that, but you'll get there pretty quickly. So the math for not using indexing is just totally devastating, capital destroying. If we can only get people to look at cost, and if we can only get people to look at the long term. And I have this sentence I've developed for investors to think about. Bill Sharp, Nobel laureate, who very much liked my addition to my extension of his original article on costs in investing. He used the 1% because he didn't take into account all the other costs. He liked my addition, and he liked my final sentence in that article, which said, I think I can get this about right. I don't think I said for God's sake, but I'll say it here. For God's sake, don't let the miracle of long-term compounding of return be overwhelmed by the tyranny of the long-term compounding of costs. I mean, just think about it in this way. You put up 100% of the capital. You take 100% of the risk, and you get a quarter, 25% of the return that you ought to be able to earn without pushing yourself. If you think that's a good deal, I think you better check your math book or something. So it's there,
Yep.
and it's true,
And it's just math.
and it's irrefutable.
Right.
The relentless rules, as Justice Brandeis said in a different context, the relentless rules of humble arithmetic.